What is a bear market and what should I know and understand? When stock prices begin falling, financial news becomes more negative, investors become more nervous, and suddenly one phrase starts appearing everywhere: bear market. But what exactly is a bear market? Is it simply a bad week in the stock market? Or is something bigger happening? Understanding bear markets is one of the most important lessons any investor can learn because every long-term investor will eventually experience one. Welcome to Simply Speaking About Money. Our philosophy is simple: budget, save, invest. And when investing, focus on probabilities, not possibilities. Today, we're going to explain what a bear market is, why bear markets happen, how they affect investors, and why they are actually a normal part of long-term investing. Let's start with the definition. A bear market generally occurs when a major stock market index falls 20% or more from a recent high and remains in a downward trend. That 20% decline is the number most commonly used by financial professionals when describing a bear market. However, bear markets are about more than numbers. Bear markets are also periods of fear, uncertainty, and declining investor confidence. People become worried about the economy. Businesses become more cautious. Consumers often spend less money. Investors begin questioning whether stock prices will continue falling. This combination of declining prices and declining confidence creates the environment we call a bear market. One of the biggest misconceptions is that bear markets are rare. They are not. Bear markets have occurred many times throughout modern financial history. In fact, bear markets are a normal part of the investing cycle. Just as winter follows summer, bear markets eventually follow bull markets. That doesn't make them enjoyable, but it does make them expected. So why do bear markets happen? There is no single cause. Sometimes bear markets are triggered by economic recessions. Sometimes they occur because stock prices have become excessively expensive. Sometimes rising interest rates slow economic growth. Sometimes geopolitical events create uncertainty. And sometimes investors simply become too optimistic during a bull market, causing prices to rise beyond what businesses can reasonably support. Eventually, reality catches up and prices begin adjusting downward. One reason bear markets feel so uncomfortable is because human beings naturally dislike losses more than they enjoy gains. Psychologists call this loss aversion. Losing $10,000 often feels far more painful than gaining $10,000 feels rewarding. This emotional response causes many investors to make poor decisions during market declines. Some investors stop investing altogether. Others sell quality investments at exactly the wrong time. And some abandon carefully built financial plans because fear temporarily overwhelms logic. History shows that bear markets eventually end. The bear market caused by the dot-com crash ended. The bear market associated with the financial crisis ended. The bear market during the COVID panic ended. Each one felt frightening while it was happening. Yet markets eventually recovered and moved to new highs over time. This does not mean investors should ignore risk. It means investors should understand that volatility is part of the price we pay for long-term market growth. Successful investors don't necessarily enjoy bear markets, but they understand that bear markets are temporary, while long-term investing is permanent. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us. because up next is a special bonus that can help you take this even further. Budgeting is step 1. Investing is step 2. That's where Acorns comes in. Acorns helps you start investing automatically, even with your spare change. It rounds up your everyday purchases and invests the difference into diversified portfolios built for long-term growth. You don't need thousands of dollars. You don't need to be an expert. You just need to start. When you pair smart budgeting with automatic investing, you build momentum, and momentum builds wealth. If you're ready to make your money work while you sleep, check out the link in the description to get started with Acorns Affiliate Disclosure. I may earn a commission if you sign up using my link at no extra cost to you.